Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I am Vivek Iyer, and with me today is Vinny Motiwala. Vinny, good morning. We started off the day slightly on the green foot. We saw a very steep sell-off, but what's actually transpired in the last hour has been a very, very strong recovery that we've seen from the intraday lows. In fact, Nifty almost touching the green point. The broader end of the markets have seen an even sharper recovery. And, some of the sectors that stand out, Vinny, there's actually one sector that you track very closely, which is the Pharma pack. Pharma pack, last couple of weeks, seen significant sell-off. And in fact, some of the pharma names today, names like Glenmark, Lupin, etc., are doing quite well.
Absolutely. Vivek, Glenmark, Lupin, you have GSK Pharma on the back of its numbers holding on to gains. So, it's interesting to watch because a list of pharma names today, even Suven Pharma is holding on to gains. We have Kaplan Point, which is doing well in trade, Piramal Pharma. So, all these which were beaten down, in the last few weeks are seeing a good move coming in today's trading session, especially on the positive side. Very, very strong moves. And GSK Pharma, let's see that also because 20% uptick is what GSK Pharma is holding on to. Very good set of numbers that was reported by the company. Other than that, some of these auto kind names. So, Ramakrishna Forgings, we have Jyoti CNC Automation, that's also in focus. And other than that, CG Power managing to hold on to good gains, Kalpataru Projects, and even Kalyan Jewellers is holding on to gains. So, it's interesting to see the market today. Obviously, they all are trading and, they also have recovered with the market when you're looking at it. Let's look at the Nifty Bank today, where that is headed as well, because if the market has recovered, we should see if that Nifty Bank is also coming up in trajectory with that. And Nifty Bank has also tried to make that bit of a comeback from the day's lowest point. A sharp recovery, though Nifty Bank is around 0.4%. As of now, mid and small cap, bit better than what we're seeing in terms of the Nifty. Small cap, one point of time, it did touch the green and again came back to the red. So, yes, keep an eye out on that. Even the Nifty mid cap is similar.
One stock, Vinny, that I want to point out from the broader end of the market is actually Manappuram Finance. Remember, the stock saw a very steep sell-off after a muted set of results, post which the stock entered the F&O ban. Today, the stock was out of the F&O ban, and have a look at the surge. This particular stock is up over 7%. But this is now a very good time to speak to Anirudh Garg from Invaset PMS, who joins us now to discuss market fundamentals and his top sectoral picks. Thank you so much, Anirudh, for joining us. First up, what does one do in a situation like this where volatility is very, very high? How are you allocating money?
So Vivek, first of all, a very good morning and thank you for having me. Vivek, as we have discussed for the past few months, maybe starting October on your show, that we had shifted to 100% cash. And now I would be in no hesitation to say that we are deploying our cash very, very actively. We were 50% invested till yesterday. Today, maybe another 20-30%. So yes, I think this is a very, very good time to invest. This is not the right time to talk about risk. Just have a diversified portfolio. Buy whatever you like in the market. I think it is going to be very, very rewarding next 2 years from here.
Hi, Anirudh. Good morning. This is Vinny this side. Anirudh, you said you're deploying cash. Where is that cash going? Which sectors are you looking at? And large and mid cap, which side is it looking at?
Vinny, the funda is very, very simple. Everything that you liked at the top, nothing has changed. Whatever you liked at the top, you're getting it at a 30-40% discount. So just go in. We are buying pharmaceuticals. We are buying electronic manufacturing services, maybe a few financial NBFCs. And then we are also stock market related, maybe some exchange, maybe some depository, maybe some brokers, mutual funds. So everything you liked at the top, nothing has changed actually in the market. A few consumption names as well, a few retail names as well. So yes, the funda remains simple. Wherever you see growth coming for the next 2 years, I think this is a wonderful, wonderful time. When capitulation happens and weak hands, they exit the market. And the fear is at its maximum. It's the best time to enter the markets.
Anirudh, especially some of the export-oriented sectors, especially names that export to the US market, names like Pharma, maybe some IT services companies, some of the commodity plays. Are you worried about retaliatory tariffs? Have you done any sensitivity analysis, especially when it comes to the pharma sector? Remember, the last 2 weeks, much of the selling was attributed to worries of tariffs coming in there. So, would you, be worried about that? Do you see further downside in case, retaliatory tariff does come through?
So retaliatory tariffs will come through, but, ultimately the business has to go on as usual. US doesn't have many options to when it comes to pharmaceuticals, especially, and IT. These are very specialized businesses. You do not have any options. You cannot take your health to for a cheaper price. You cannot take them to countries who have not specialized in it. So Indian pharmaceutical companies, Indian IT companies over the past 3 decades, with the support of the government and the extraordinary entrepreneurs that you have in these sectors, have excelled very much. They have a lot of expertise, and everybody post-COVID knows that alternate to China has to be made. So I think these US tariffs in will be a best blessing in disguise for the Indian pharmaceutical and IT companies. And owing to their specializations, the better ones, the ones which have a hold of their businesses, will excel.
Absolutely, whichever hold of your businesses will excel. That's how we're coming in on those, US-based export-oriented stocks. Anirudh, specifically, anything on the banking side that you would be looking at? How are you looking at these banking or financial names?
Not to take names, but we are looking actively at some consumer finance companies. I think there is another relative change that has happened in the market, and that is that the budget stops, the income tax cuts that the government has given to the middle class, and ultimately it will translate into uh, good profits in the coming couple of years for some consumer finance companies.
Anirudh, what we want to understand from you is right now you've said very openly that the last couple of trading sessions you believe there's been quite a bit of a capitulation and you've added aggressively to some of the bets that you liked. Any sectors, even at current levels, that you look to avoid? The second question is, especially capital goods names like Siemens, Cummins, even a name like L&T have actually corrected quite significantly from the top. Do you like any of these names?
Oh, they are a 15 to 20% of our portfolio. Some good names here. So we like capital goods. The valuations have corrected, and these companies are wonderful companies. We're just sticking to the leaders here for now, because there is only one negative thing that is happening in India. That is the free swaps that the government is giving in the elections. But I think now the election season is a bit over. Again, the focus will shift to capex, and the valuations have corrected immensely. We were amazed that you are getting two ABBs for one ABB, which was trading 3 months back. Yeah, so wonderful, wonderful, wonderful valuations. And I think it's a time to buy everything that you like. It's just
Anirudh, when you
if
say
buy-
say it as a negative, are you worried that capital goods companies are finding it tough to find labor? Is that what you are alluding
no,
to?
no, 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 no. I see the fund kitty is limited. So if
Right.
you keep on giving swaps, then
Okay.
ultimately it's the capital goods that suffers
Capex,
historically.
right,
Yeah,
right.
yeah. So that is some worry. But when it comes to the leaders, they are the people that you have to opt to. When there comes a crisis, a little bit of crisis in a particular sector, the leaders, they excel and take a better seat. So I think the leaders here in the capital goods sector in various industries should do better.
Okay. Anirudh, you mentioned consumption is also something that you all are looking at. What I want to know is it going to be more staples or discretionary side is what you're looking at?
No, we are not very, very bullish on the discretionary side, neither on the
Okay.
staple side. We are more bullish on the new economy side of consumption.
Oh, okay.
Okay.
Yeah.
So that's something like a Zomato, Swiggy and all is what you're looking at?
Yeah,
We have
no,
only two
Zomato,
names.
Swiggy, no, there are some other names as well. But unfortunately, we're not allowed to
Okay.
take names.
Sure.
But yes, there is a lot of change happening in the. I do not like these two companies as per se, because I believe there is too much competition here, and with an active number of competitors joining in, I believe it will be very, very difficult for them to excel in the coming few years. There are some other wonderful companies, we are looking at some companies in retail as well, some from the biggest groups in India.
Right. Names like Trent, etc., which have corrected quite
Yes, they are
significantly.
wonderful companies. Wonderful
I'm sure you
companies.
have your eye on them. Anirudh, one thing which we want to understand from you is within the financial space, right? There are PSU banks, there are private banks, NBFCs, MFIs. A lot of them have seen significant correction, especially names from the MFI space. Could you make a basket for us as to which are the companies or which are the pockets within this financial space that you like currently?
See, so I think the entire financial space, when it comes to the scenario that we are in, financials do very, very well. So we like PSU banks as well, though we've not bought them currently. We're waiting some more. We like, as I told you, consumer finance companies. We like some big banks as well, big private banks as well. We are generally more inclined towards the entire the entire financial space. MFSI is sorry, these all these um, uh, companies which cater to small loans, very, very small loans, is something that we don't really track that much, because for us it is very, very difficult. And for the management talks that we have, I think they all take it as a compulsion from the government, rather than they're not very bullish. They don't like it, so we also don't like it. We like companies in finance where there is self-sustainable growth.
Okay, so the MFIs, the place where you've seen maximum pain, are places that you continue to stay away from. What is the reason for that?
Do you stay away from? But we, on the same time, we say that the valuations have become extraordinarily attractive.
Right. Thank you so much, Anirudh, for joining in. Last time around when you joined us, you called for the correction has come, and now you're sticking your neck out and saying that you are deploying cash as far as markets are concerned. Thank you so much for joining us. Well, let's now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Welcome back and thanks for staying tuned into Trading Hour on CNBC-TV18. Now let's shift focus and talk about what's happening in the world of commodities. And Manisha, I see that you're talking about coffee and not such a great news coming in for coffee lovers, at least in terms of prices.
Oh, well, absolutely. And that clearly was the case last year as well. But we are looking at higher highs and more build-up in those prices in 2025 as well. So when you look at the Arabica coffee, and that is the most traded one globally, we are looking at prices at all-time high is one. And the prices have gained up by 31% in 2025. If you look at the last 12 months then, and we've seen prices up by 120%. That's the kind of run-up that you have seen. The other variety, which is Robusta, that also has seen a gain of 60% in the previous year. And the prices for Robusta also are up by nearly 15% for this year as well. Well, the Indian CPI data came in last week, and that shows you that for the month of January on a year-on-year basis, we have seen prices gain up here as well. So when you look at roasted prices, that's up by 2.5%, and the instant coffee prices are a big jump of 7% in matter of last 1 year. There have been various reports as well, and the roasters coffee report suggests that prices will increase by 100 rupees in the month of February and another 100 rupees in the month of March, because they will be passing those prices on to consumers. Interestingly, it really has been about weather concerns in major growing areas like Brazil, Ghana, and also Ivory Coast, where the inventories are also on the lower side. That has been keeping the coffee prices on the higher side. The demand has been strong, and out-of-home coffee consumption has been rising as well, keeping support at even these levels in sense of prices.
Thank you so much, Mani, for joining us as well as giving us a sense of how exactly coffee prices are panning out. Let's now slip into a short break. When we return, we will discuss market technicals with Soni Patnaik of JM Financial Services and also discuss her top trading bets. Welcome back to Trading Hour. Well, the brief respite that we saw from the selling pressure has once again ebbed away. In fact, Nifty once again has seen cuts of now trading with cuts of close to 0.5%. The mid-cap, small-cap index are both much lower, and the bank Nifty is the one that is down almost 0.7%. In fact, a name like AU Small Finance Bank trading near the day's lowest points. But one stock in focus today is Mahindra and Mahindra. Remember, the company got over 30,000 bookings for the electric SUVs on the first day. But the stock is under pressure. Sudarshan tells us why the street is disappointed with these sales numbers.
So while the stock is under pressure, down nearly 4%, but as far as the booking data for recently launched electric vehicles XEV9e and B6 are concerned, the booking data is looking strong. Company has announced that on the very first day of the booking, it has received bookings of around 30,200 units with total booking value of around rupees 8,500 crore. So there is nothing to complain on that front. Also, most of the brokerages remain positive on the stock. Citi has a buy call with a target of around rupees 3,700 per share. It says absolute volumes of EVs are much lower than some of the recently launches that company had made, but some of the recently launches that Citi is comparing, it's against the petrol and diesel vehicles that company had launched. Also, it says it needs to see how the EV facility ramps up and what is the cancellation rate for these two electric vehicles. Nomura 2 has a buy call and target is around rupees 3,700 per share. It says it's impressive start for electric vehicles with 30,000 bookings. Also, company has received 56% and 44% bookings for 9E and B6, and this order book is a very strong number. GS2 has a buy call with a target of 3,800. It says 30,000 bookings to employ 8% incremental SUV volumes for FY26, and B6 and XEV9E models to collectively contribute 8% and 18% to FY26 SUV volumes. LR2 has a positive stance on the stock. It says 30,179 bookings seem to be very good in its view, and strong demand and new launches will be key to achieve that company has targeted for FY27. So there is nothing to complain on the booking front, but it seems that stock is seeing profit booking as it has outperformed its peers if you look at the stock data for the last 2 to 3 months.
Okay, so Darshan, thank you so much for the update coming in there. As of now, M&M is down almost 4%. But let's move on and pull up the charts for Biocon. That's in focus as well. Was trading with mild positive, but now has seen a decline. Why? We have some negative news flow that's come in for Biocon. And what is it that the US FDA has now approved the first ever rapid-acting insulin biosimilar product for the treatment of diabetes, and this is from Sanofi's stable that has come in. And now, what we knew is that Biocon was working on this. They were working on these biosimilars. There were trials going on. They had filed it with the US FDA as well. Now, obviously, competition has gotten the approval first, so a bit of a negative on that front. The US FDA has granted this approval. The drug is called Merilog, and this is from Sanofi US LLC that has come in. Currently, they've gotten an approval for both the 3 milliliter single patient use pre-filled pen as well as a 10 milliliter multi-dose vial as well. So both of these have gotten an approval from the Sanofi side. And addressable market overall for this is an insulin aspect which Biocon was focusing a lot more on. This was going to be one of those key drivers for Biocon in the next couple of years. And analysts were also very positive on this one. Now competition obviously has increased. So addressable market in the US is around $651 million, while in ex-US it is going to be $1,287 million. As of now, when you look at it in the European market also, there are two companies who are already selling this. And that is Sanofi as well as Eli Lilly, and this is in the Europe market. Now, this is obviously about US FDA, so the US front, but Vivek, it's nothing very exciting that you're watching out for. A bit of a negative because the competition has come in before,
right,
and we'll have to see how this actually goes going forward.
Well, on the back of that development, Winnie, like you pointed out, thank you so much for that. Down over 1.5%. As we slip into a short break, this is a small programming note for our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact, and shaping the future. Nominations are now open. Scan the QR code now and submit your entry for SME Champion Awards Season 2.
Welcome back and thanks for staying tuned into Trading Hour on CNBC-TV18. Now let's bring on board Soni Patnaik from JM Financial Services, who are joining on with us to give us a quick take on the technical front. Soni, good morning. And today markets, yes, opened up in the green, saw a sharp fall, now a recovery. What are we watching out for from the Nifty as well as the Nifty Bank point of view?
Hi, good morning, Vinny and Vivek. Thank you so much for having me on your show. So I think Nifty is sustaining continuously below the 23,000 mark. Significant call writing can be seen between the 23,000 to 23,300 strike prices. And put writers are sort of trying to base themselves at 22,800. So it may remain in this 200 points range, but if a closing comes below 22,800 today, then Nifty can head towards its lower support levels of 22,500. I think it's a sell on rise still, and until and unless the 23,000 level at the bare minimum is not taken out for Nifty, it remains to be under pressure and a sell on rise can be seen. So if you talk about Bank Nifty, I think Bank Nifty is approaching the support of 48,000. If it holds, you can see a bounce back, but even Bank Nifty has a strong sell on rise structure. And a good recovery or a good reversal can only be seen if Bank Nifty takes out the 50,000, 50,200 mark, which is quite far-fetched from current levels. I think both the indices remain pressured from current levels. Our advice would be to remain cautious and remain hedged when it comes to the indices.
I understand that's only better to remain hedged is the advice that you're giving. Any individual stocks that you like or dislike at current levels?
Certainly, Vivek, it would be a balanced approach with a buy idea and a sell idea. The sell idea comes in for Petronet, which is given a very fresh breakdown below its 300 mark. So one can sell Petronet futures on rise up to 292, keeping a stop loss of 306 and targets of 275 to 265 can be seen. The buy idea comes in Bajaj Finserv, which has given a very fresh breakout on daily charts today. And call writers seem to be exiting at higher strike prices. Put writers are forming a base at higher strike price. So Bajaj Finserv looks quite strong. One can buy at current levels, keeping a stop loss of 1850 and targets of 1930 to 1940 in the coming days can be seen.
Okay, thank you so much for that, Sony. But on that note, thanks so much for joining in. Now, let's move on and get to some news coming in from the insurance space, as the insurance regulator has emphasized the need for insurers to have a roadmap for listing. We understand that insurance companies have now sought more time. Yash is joining with us to give us more details on this. Yash?
Well, it was just last month when we at CNBC-TV18 had reported that the insurance regulator, that is IRDAI, had asked for a public listing plan from some of the large as well as old general and life insurance companies. The last date for the submission of those public listing plans was by the end of January. What we've been given to understand from our sources now is that that particular public listing plan or a feedback on the regulator's request to submit the public listing plan has been submitted by these life and general insurance companies, and at the moment there seems to be some more waiting. The reason is because these life and general insurance companies at this point of time seem to be a little hesitant when it comes to submitting that public listing plan. The rationale is that these life as well as general insurance companies are of the view that there are some very large accounting reforms which are awaited by the sector as far as implementation is concerned, and the balance sheets of these life as well as general insurance companies will significantly change once these large accounting reforms have been submitted and implemented. What are these large-scale accounting reforms? The first one is IFRS, that is International Financial Reporting Standards. The second one is risk-based capital or RBC, and the third one is risk-based monitoring or RBM. The life insurers as well as the general insurers feel that they would be able to submit this public listing plan with the regulator once these accounting reforms have been implemented. That's because it will be better, according to them, to go to investors, to go to public, to raise funds and get listed on the exchanges once the balance sheets are reflecting these large-scale accounting reforms. Which are these life and general insurance companies which have been asked to submit their public listing plan? Some of the largest life and general insurance companies: HDFC Ergo, IFCO Tokyo General, Tata AIG General, Bajaj Allianz General, Bajaj Allianz Life Insurance, SBI General, as well as Aditya Birla Sun Life Insurance. Some of the companies which are expected by the regulator to submit these public listing plans by them. The regulator, in a recent meeting with the insurance CEOs, again emphasized on this particular point of public listing and hence more transparency in balance sheets.
Thank you so much, Yash, for joining us and giving us a sense of the listing roadmap as far as public insurers are concerned. Let's now take a short break. We'll get you excerpts of our chat with Sanjeev Prasad of Kotak Institutional Equities on the other side. Well, welcome back to Trading Hour. Well, let's now get to some important market opinion we got earlier today. Sanjeev Prasad of Kotak Institutional Equities weighed in on the market fall, says he still sees froth in the market. He also added that foreign inflows are unlikely to come back in a hurry as India faces the twin challenge of lack of flows in EM funds along with the growing preference for China.
And if you look at the valuation of the large cap index, let's say the Nifty 50 index, it's not too bad, roughly about 20 times 1 year forward, about 7.5 on a March 27 basis. There will be earning downgrades, I'm sure, in some of the sectors. But broadly speaking, I don't see too much downside, as far as the large caps or some of the large caps are concerned, namely the financial names, IT, Pharma, etc. Yeah, there are still pockets of overvaluation even in the large cap, but I can live with that. The problem still remains in the mid cap and small cap, areas. That is sector will dominated by mid cap, small caps, or the mid cap, small cap stocks. Still a lot of froth over there, and I think you would see a lot more correction over there because the fundamental value of many of these companies are far lower than whatever the current market caps and prices are. I mean, you talked about RVNL. Just now. I mean, the market cap of the company is something like 75,000 crores even now, by the way. Yeah? I think it is still at about 8 times book value, if I remember the book value correctly. Yeah? And about 40 times on March 24 profits. And the railway budget this time around, there's no growth in the railway budget, right? So where is the growth going to come from for some of the railway stocks which had become very, very expensively valued? So there are still pockets of, I would say, froth in the market, and that will get flushed out over the next few weeks. Looks like the way the market is going.
Sanjeev, I was looking at this data point in the morning. If you look at the small cap index, right, with this correction we've seen, the 10-year CAGR now has fallen to about 11%, which is in line with the long-term average now. The mid-cap CAGR 10-year is now about 14%, is 14%. Again, it doesn't seem, I mean, that excess or excessive kind of froth seems to be out, but of course these are averages. The other point is markets really settle at averages, right? They overshoot and then they undershoot. But you're saying on an absolute basis as well, and you gave us that example of RVNL, there are large pockets of overvaluation and excesses, right?
Absolutely. There are just so many stocks here, especially in the mid cap and small cap areas, So either you have, companies which are trading at very expensive valuation but have decent fundamental. These are the high growth companies, let's say in the capital goods space, EMS, etc. But we just struggle with the valuation of these companies, and they are so much priced to perfection, even now, by the way, despite coming, down 20-30% from their peak level. So any disappointment, you would see a big, cut in the market price over there. And then you have many other stocks which are not displaying any great, numbers, especially on the consumption side, and the valuations are still very, very rich, and in most cases the multiples are significantly higher than the pre-COVID levels, and the growth is significantly lower than the pre-COVID levels, so which makes no sense really. And in many cases you are seeing a lot more disruption, medium-term challenges, structural issues cropping up, which were not there 5-7 years back when the market was willing to give much higher multiples to the same sector in stocks. And then you have a bunch of completely rationally valued, sectors and stocks which have no real fundamentals, but the prices have gone up, very high for whatever reasons, and now they are giving way, and these will correct really, really badly, and unfortunately a lot of retail money is over there from whatever I have looked at some of these stocks.
Sanjeev, just very quickly, at a headline level, I was looking at, for instance, some of your peers, Motilal's note, they were saying for FY26 the Nifty estimate is around, I think, 1203, 1203. And they feel that expecting a 15% CAGR is very excessive right now. Where are you on the headline earnings trajectory for FY26? Whether it's the Nifty 50 or the BSE 200, some of the wider indices, what is that big number that you are going with?
So for FY2026, we have 14.9 or 15% growth, let's say, rounded out to 15%. That's on the back of 4% growth in FY 2025. But anyway, 2025 numbers are distorted by, much weaker numbers for the likes of BPCL, HPCL, which is not part of Nifty, but through NGC, these numbers come. And also coal had very high numbers in FY 2024. You will have a big decline over there compared to FY 2024. So if you look at without these three companies, which is probably right to look at it because there's a lot of volatility in the numbers of these three companies, then the FY 2025 net profit growth will be 10%. And for FY 2026, now, as of now, we have 14% growth. And I think the EPS number is about 1180 or so for FY 2026.
You're saying
so again, the Nifty is not a problem. If you look at the banks are reasonably...
Sorry, Sanjeev, you're saying the Nifty...
14% growth if you take...
Yeah. And X of which companies did you say that the growth number comes down to 10%?
BPCL, HPCL and Coal India. HPCL is not in the Nifty, but its numbers get consolidated with that of ONGC, and ONGC is in the Nifty 50. And there's a lot of volatility in the numbers of these companies. By FY 2024, if you recollect, you had very, very high profits for BPCL and HPCL. And also coal had this one-time benefit from the change in their accounting policy for the overburden removal, which boosted 2024 numbers significantly. Which is why if you look at the FY 2025 headline number, it is only showing a 4% growth. So that's why we now remove BPHP and coal from the calculation completely. And if you do that, then the FY 2025 Nifty net profit index, Nifty 50 index net profit growth comes to 10%. And on a like-for-like basis for FY 2026, it comes to 14%. So there will be some downgrades, but I think 12-13% it seems achievable for the Nifty 50 as a whole. See, Nifty 50 again is not a problem. You have companies, like the banks, etc., which are not seeing really any challenges as of now, or especially the banks which are Nifty 50. There are smaller banks who are seeing a lot of issues in the MFI, loan book, and so on and so forth. But there are no real asset quality issues as far as the larger banks are concerned. If you look at IT, Pharma, which are another very large portion of the index, they are getting some tailwinds from the big INR depreciation that you have seen, and some recovery, and anyway, pharma companies are doing quite okay. So that's not the problem. The real problem, as I keep saying, is beyond the large caps.
Sanjeev, the other question, and you'll have so many foreign investors also at the conference, right? Foreigners have sold some $21 billion of Indian stock from the peak in late September last year. So this year, I guess, we're giving back some of the crazy run over the last few years. But global equities generally seem to be, we're looking at Europe, for example. The Euro Stoxx 50 has come back to its same level as year 2000 after 25 years. Things are rising from the dead. China, for example, has started on a good note. Mostly tech, though. Does this mean more competition for this foreign capital? Because there was this argument which was made last couple of years that, there's only US and India, and that played out, for a while. Where do you stand on foreign flows, Sanjeev, from here on?
The foreign flows, I suspect, we should assume for the time being it's not coming back in a big hurry. And the reason for that is pretty simple. There is no new money coming into emerging market funds for the time being. And I don't see why that situation should change in the next 2-3 months at least, given the fact that the US market is doing very well. We have a lot of, policies which are still evolving, as far as the new US administration is concerned, which could work against the EMs for, if you see more, tariff being put on exports from some of the emerging market countries. So as of now, I would say most asset allocators would be a lot cautious on emerging market. And that's been the theme for the last, 3-4 months now. This whole thing started from late September when, first of all, I'm talking more from India perspective, first you had the India to China pivot, when China announced, a host of policy measures, fiscal and monetary, to reboot the economy. And very quickly, by end October, when the chances of Republican Party winning all the three arms of the US government, started to build up, the so-called Trump trade, you had a pivot from EMs to the US. And that trade, unfortunately, has continued, from a perspective of EMs. And you see the fundamental problems still remain the same, right? If you look at the performance of emerging markets, it's been a disaster for the last 10 years. The MSCI EM index is up 13% in the last 10 years, cumulative that is, which means 1% CAGR. Against that, the S&P is up 200%, so that means 3x. Nasdaq is up about 300%, that means about 4x, by the way. So that's the comparison. an asset allocator, which could be an endowment fund or a pension fund sitting in the US is looking at. And everybody looks at trading returns, and decides, okay, fine, US is the market to be in. Plus, you don't have worries about, currency and so on and so forth. So why bother? And I suspect that may continue till the time either something goes wrong in the US, but obviously then it means pain for the rest of the world also. Or, somewhere EM valuation come to a level where, people, start looking at it a lot more favorably, which is what seems to have happened in the case of China at least. Valuations were attractive. Certainly you have this excitement around, DeepSeek and AI-related tech. You have seen all the tech companies, bouncing back, and also China has decent, tech companies. So that is excitement now, but remember, it is basically the same money which is rotating between various EM markets. And unfortunately, India will not get any money in the process, because if China's market is doing well, India will probably struggle, which is the second leg of the problem. So first you have an EM to US problem. Second is, as of now, looks like again you have India to China pivot, which is going on.
Okay, on that note, we're actually going to slip into a very short break. But here, as we slip into a short break, some good news for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, as well as financial world updates at your fingertips. Download the CNBC-TV18 app from your Apple Store or Google Play Store, or you can just scan the QR code on your screens.
Welcome back to Trading Hour. Well, very few bright spots amidst the selling pressure that we're witnessing across the markets. A couple of names doing quite well. One from the broad end of the market, which is Alchem Labs. That stock trading near the day's highest points. Remember, very good quarter as far as the company was concerned in terms of the EBITDA margin. Nestle is the other stock on the radar. That stock too is doing quite well. But on the other hand, one stock that's seen selling pressure intensify in the last in the last half hour or so is actually PB Fintech or Policy Bazaar. That stock has seen significant selling pressure. So too has Supreme Industries. That stock too down close to 5%. But Vinny, you've been tracking Glenmark Pharma. The stock is doing quite well. Earnings came over the weekend. How did it look?
So earnings, Vivek, is not that exciting. When you look at the numbers, actually the first thing, net profit, yes, surely came into net profit versus loss, but there was those inventory adjustments that came in, which one has to take care of as well. 35% revenue growth. Now, research and development for the company, the expenses over there had seen a sharp fall of 27%. Their margins are at 17%, which is below the guidance is what they'd given. And price erosion that we've seen in the US for the last few quarters is something that impacted the performance in US. Now, what is interesting and why the stock started buzzing in trade is that we had the highlight that came in from the con call today. They're maintaining their FY25 guidance in terms of both revenue as well as margin. Despite them being at 17% this quarter, they believe that this 19% target that which they'd given previously is something that is achievable, and they will see a sharper recovery coming in. Other than that, 9-month period also, they're saying that overall it's 18%, so they can manage to come back to that 19% mark of the guidance. FY26, they see a further margin improvement of 1 to 1.5%, so keep an eye on that. And they said that for revenue growth, 9 to 10% revenue growth is what they could sustain. Even in Q4 is something they're maintaining a good growth, and overall for FY25 a 9 to 10% growth. And they said that they have none of the pending filings from Indore unit which has received observations, so nothing is pending on that front. So that's a bit of a positive, and that is why the stock has seen a sudden run up coming in trade. An uptick of 4% as of now is what we're watching out for.
Well, that's a relief rally that Glenmark Pharma is seeing. Last week, remember, the entire pharma pack, even the realty pack, had seen significant sell-off, but Glenmark Pharma today bouncing back quite sharply from those lows. With that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime report is up next.